Alright. Watching, guys, watching. Which one moving? Today is kind of slow, very slow, guys, very slow. Slow, slow, slow. Slow, slow, slow. Pum, pum, pum. Pum, pum, pum. Pum. Very hard to treat, guys. Nothing today. Chesta. Chesta is crazy, okay? Chesta is crazy. Look, Chenta. It pump right here from here all the way to 13. Crazy. No bottom, no tree. Come on, see what one pumping. Pump, pump, pump. No pump. No new, nothing. Very slow. I got good trade on this one. MA. Got Good trade on this one, okay. What's that? MSEI. Sell all the way up here. Crazy. Good trade on this one. Crazy. This one here, you see here, double top. Exactly hit right here, double top. I jump in right here somewhere. Sell all up here. Crazy, huh? That's all, guys, because this one double top right here. This is a 20-day. This one today. Double top. So right here today, this 20-day, this 15-minute chart, this one 2-minute chart. Look, it's very clear, it's classic. This one break right here, 140, you see the moon. See the moon, guys. Alright, look at this one. Daily chart. Or look daily. 100-day, look at this pump. Exactly right here, huh? See? Classic. Start to come down. Right here. Perfect. WVE. Let's see WVE. What the heck is WVE? Breakout right here on the base. This one look okay. You can jump in the 835. 835. See a lot of resistance 835. See. $8.35, $8.30 right here. See. A lot of resistance right there. Break resistance, pull back. You can jump in second time. Right here, PPBT. Got this one here, 261 right now, 242. Underwater, PPBT, this is a good one. Buy 123, 123, sell all the way here, 138, 138, 37. Look. This one, they don't let me buy this one. EDHK, they don't let me buy it. I got no idea. They don't let me buy it. That time 90 cents, 80 cents, they don't let me buy it, guy. I got no idea. Broker, don't let me buy it. Coming right here. Watch out, this one break 105, okay? 105 right there, see? OCCO, BP. Let me tell you where my setup is. I love setup like this. Show you. Okay. Right here, this is my setup right here. When everything curve back up, pull back, I love to jump in right here. Because over here, I know where to get out. I get out down here. That's why I love to get in right here. Okay? Symbol with this one right here. Symbol this one working. Today this one work. Okay, this one pump all the way here. I know it's 130. A lot of resistance. Pull back here. I jump in right here. Okay. I jump right there. What time is that? About 10 o'clock. About 10, 11. I jump in right here. Because down here I get out. And then pull all the way up here. I say up here because the resistance up here, 140. Resistance right here. Pull back, boom. That's a good setup, guy. Right here, this is a good setup right here. Volume pick up, perfect. Look. This is a perfect trade right here. You see 10, 11. Get in 123, 123. Buy all the way to 19. And then boom. Crazy. That's a good trade. Right here. This is a good setup, guy. Pull all the way so much. Trade up. Need to pull back. Ball plus. Jumping right here. That's crazy. This is a good one right here. See? 1920. Right here, 1920. Right here, 120 right here. See? 1920. Boom. Sell all the way up here. And then it pull back. Look at it pull back. You have second time, but this one backside. Backside not stronger than front side. See this the back, this side the back. It's not stronger than the front. The front right here strong. Boom. That's a good setup. I like the setup. You know where to get out and know where to stay. Okay, here too. PP, BT, PPBT. Look at it. PPBT, straight up, look, same chart, straight up. You need to pull back, pull back, pull back, pull back. This is a good time to get in right here, guys. A lot of waiting, guys. Be patient. This is a good time. Market open. I jump in there, but I don't sell. I jump too late. I jump all the way up here. And I get out, lost $11. It quick break out right here. You need to The dumb right here, guys. 130, 140. 140, the dumb right there. It's dead. The market dead today. Watch out this one right now. Pull all the way back here. Look straight up. Pull back. Go all the way, pull back. All the way, pull back. This one need to pull back for sure. Let's watch. Pull back for sure. $1. Okay, 405, 410. 410 resistant. Resistant all the way here. The volume pick up right there. 410, guys, 410. Very hard to break $4, okay? Look here. You see the volume? Look at it. This one is called reversal volume. Who somebody dumping or selling right here. Okay? This is a classic. Something going on here, okay? You see here the volume all the way 400,000 here. But not moving. It's building the Dolce. Building the Dolce. No good, guys. This is no good. See? You have to look at the volume. You see $4? Somebody's selling or something right there. You see, when you see a lot of volume, must be pushed out, right? But nope, it's stuck right there, so no good. Slow day. Today's slow, guy. Very slow. Nothing happened. Slow day.
You know, there comes a time in every trader's life when he has to look himself straight in the eye and say, stop before you blow your account.
You can see that?
Because make no
I
mistake,
told you that's the volume right there,
an
guys.
endless supply of lessons.
Right here, this is a reversal volume right here.
You can always come back from a bad trade, but it's a hard thing to come back from ruin. And that's
See?
what we're talking about.
I say be careful here, I don't like
In the
it. You
previous
see
video on
here?
trade consolidation zones, I told you that patience was the trader's secret weapon. Well, this is the flip side of that same coin. Restraint. Knowing when to stop. Knowing when to sit tight. Now, I've seen it happen more times than I care to count. A trader catches a streak, Thinks he's found the rhythm of the market, starts pressing his bets. Then one day he wakes up and finds that same market, his so-called friend, has turned against him. The account's bleeding red, the heart's pounding, and the fingers are itching to make it all back on the next trade. Has that ever happened to you? That feeling of wanting revenge on the market? You see, the market doesn't care about your emotions. It doesn't know you exist. It moves to its own rhythm. And if you start trading out of frustration or fear, you're finished. You've stopped being a speculator and turned into a gambler. And gamblers don't last long. Every blown account I've ever seen started the same way, with one trader who couldn't stop when he should have. The biggest mistake a man can make in this business is to think the market owes him something. It doesn't. The market pays only the man who waits for the right setup,
Always.
and who protects his stake. The capital is your lifeblood. It's the ammunition that lets you stay in the game. You wouldn't go to war and waste all your bullets in the first hour, would you? Then why do traders empty their accounts chasing noise and emotion? Let me tell you something. The great moves, the kind that build fortunes, they don't come every day. They don't even come every week. The market spends most of its time going sideways, luring the impatient into traps. Remember what we discussed in that earlier session about consolidation zones? That's where the untrained eyes see nothing, but the patient trader sees the coiled spring. The same principle applies here. You don't need to trade all the time. You need to trade right. There were times in my own career when I made a small fortune, only to watch it slip away because I got greedy. I thought I was smarter than the tape. I thought I could force a profit out of the market when it wasn't ready to give one. But the market has a way of humbling every man who tries to outsmart it. The lesson I learned, the hard way, was that it's better to be out of the market wishing you were in, than in the market wishing you were out. Now let me ask you, how many times have you doubled down on a losing position, telling yourself it'll bounce back? How many times have you said, just one more trade and I'll be even? That's the voice that leads men to ruin. The market doesn't care about your average price or your ego. It only cares about what's happening now. And if you can't accept being wrong, if you can't cut a loss quick, you'll never stay solvent long enough to be right. Here's a truth most traders never accept. The best trades are often the ones you don't take. There's wisdom in doing nothing. There's strength in waiting. The amateurs think action equals profit, but the professionals know that patience equals survival. If your setup isn't clean, if the tape isn't confirming your read, then step aside. Keep your powder dry. There will always be another opportunity, but there won't always be another account. A trader's greatest weapon is not his system, nor his indicators, but his self-control. Without discipline, even the best strategy will fail. You can have perfect chart analysis, tight risk management, and still lose if you can't control your impulses. Think about it.
Discipline, baby.
Recognizing a consolidation zone or spotting a breakout if you can't stop yourself from overtrading before it happens. That's how today's topic ties back to what we covered before. The structure of the market means nothing without the structure of your mind. When the tape turns against you, the only sane move is to step back and wait. Don't argue with it, don't fight it. The tape is never wrong, opinions often are. I used to tell myself, if I can't make money sitting, I'll never make money trading. That was one of the hardest lessons to learn, but it saved me from disaster more times than I can count. Do you know what separates the speculator from the gambler? It's not luck, it's control. The speculator studies, plans and acts when the odds are in his favor. The gambler jumps in hoping to get lucky. And hope, in trading, is the most expensive emotion of all. You have to strip it out of your system. The only thing you can rely on is your preparation, your timing, and your discipline. Let's talk about that word, discipline. It sounds simple, doesn't it? But it's the hardest part of the job. The discipline to stop trading when you're on tilt. The discipline to walk away after a winning streak before the market takes back what it just gave. The discipline to risk small when your confidence is shaken. Most men don't fail because they can't trade. They fail because they can't wait. And when you think about building wealth from trading, don't think about making it all in one swing. That's not how real money is made. It's built trade by trade, patiently, like bricks laid over time.
Hey traders,
Protect your base
awesome
capital,
to
and it will protect
here.
you.
Yeah, thanks for
Load it,
joining.
and the market
Just an
won't even
important
notice you were
announcement.
there.
This stream
Your
is
job is to
delayed.
stay in the
If you wanna
game
get
long enough
access
for the
to
big
live
moves to
features,
come.
so the live
And they will
stream,
come
live commentary,
if you have the patience to wait
access
for them.
to our private
So when you find
Discord
yourself
chat,
tempted to force a
that
trade,
is the
to
link
push
that
when
we
the
found
tape
in
is
the
dull or
description
choppy,
just under this
ask
video,
yourself,
guys.
am I
And
trading
also, I would like to
opportunity,
ask
or am I
you
trading
kindly to
boredom?
hit the like button,
Because boredom
subscribe
has
to the
cost
channel if
traders
you
more
haven't
money
done that
than bad
already.
signals ever
And
did.
again, I'll see you
The
guys
market
out there.
doesn't
Thank
reward
you.
impatience, it punishes it. Every trade you take should have a reason, a plan, and a stop. And when that stop is hit, you don't question it. You obey.
Look at that
The
guy.
trader who can take a small
WB.
loss without complaint is the one who stays long enough to take a big win. The man who can't stop, who keeps chasing after the market, is the one who ends up watching his account disappear digit by digit. I've always said, the hardest thing about trading isn't learning charts or strategies. It's learning yourself. The battle is internal. The market only exposes what's already there. Your fear, your greed, your impatience. Once you master those, the market becomes a lot simpler. But until you do, it'll keep teaching you the same lesson over and over. Stop before you blow your account.
So right here on the emotional fear
That simple idea has
greed,
saved more traders than any strategy ever written down.
and
But it's the one
patience.
rule most people can't follow. Because doubt makes you uneasy, and the human mind hates uncertainty. You want answers, you want direction, and you want it now. But the market doesn't operate on your schedule. It speaks in its own language, in its own time. If you try to force it to tell you something before it's ready, you end up mistaking noise for truth. And that's how accounts get drained, not by big crashes, but by small, impatient guesses made in moments of doubt. Every trader knows that feeling. The chart's not clear, the candles are messy, and your conviction starts to fade. You find yourself clicking between time frames, zooming in, zooming out, trying to find a reason to act. You start thinking, maybe I'm missing something, or I can't just sit here doing nothing. That's when trouble begins. Because when you're uncertain, any action, trading isn't learning charts or strategies. It's learning yourself. The battle is internal. The market only exposes what's already there. Your fear, your greed, your impatience. Once you master those, the market becomes a lot simpler. But until you do, it'll keep teaching you the same lesson over and over. Stop before you blow your account. When in doubt, stop trading and let the market speak. That simple idea has saved more traders than any strategy ever written down. But it's the one rule most people can't follow. Because doubt makes you uneasy, and the human mind hates uncertainty. You want answers, you want direction, and you want it now. But the market doesn't operate on your schedule. It speaks in its own language, in its own time. If you try to force it to tell you something before it's ready, you end up mistaking noise for truth. And that's how accounts get drained, not by big crashes, but by small, impatient guesses made in moments of doubt. Every trader knows that feeling. The chart's not clear, the candles are messy, and your conviction starts to fade. You find yourself clicking between time frames, zooming in, zooming out, trying to find a reason to act. You start thinking, maybe I'm missing something, or I can't just sit here doing nothing. That's when trouble begins. Because when you're uncertain, any action feels better than waiting. You convince yourself that doing something is progress. But in trading, uncertainty is not a call to act. It's a signal to pause. The best traders in history understood this. Your job isn't to predict. It's to react when the picture becomes clear. The market always tells the truth, but it doesn't always tell it immediately. It takes time to form direction. It needs to show its hand. And when you're in doubt, that means the hand hasn't been revealed yet. Maybe the volume's low, the price action's choppy, or the news cycle's distorting the tape. Whatever it is, the signs aren't aligned. That's not a weakness. It's information. It's the market's way of saying, stand aside, watch. When you force trades in those conditions, you're no longer speculating, you're guessing. And guessing is a luxury you can't afford in this business. Doubt is part of trading. It never goes away. Even the best setups come with uncertainty. The difference between a professional and an amateur is that the professional respects his doubt. He listens to it. He lets it keep him out of bad situations. The amateur treats doubt like an enemy, something to be defeated with more analysis or more trades. But in truth, doubt is a guardrail. It tells you when your vision's clouded. It reminds you that there's no shame in sitting out a trade. The cost of missing an opportunity is nothing compared to the cost of trading a bad one. Think back to what we discussed in the previous video on how to trade consolidation zones. Remember how the market compresses, building energy before the breakout. That period of uncertainty, when the range tightens and nothing makes sense, is when doubt creeps in. The impatient traders start guessing the direction. They want to be the first to catch the move. But the disciplined ones wait. They let the market speak first. When it breaks cleanly, with confirmation, they act decisively. The same principle applies to every kind of trading. When you don't know, wait until you do. Ask yourself this: how many of your biggest losses happened when you weren't sure but traded anyway? Most traders, if they're honest, will tell you the same story. They saw a setup that wasn't perfect, hesitated, then convinced themselves to take it anyway. They said, "I'll just try a small position," or "It looks good enough." But good enough is another word for uncertainty, and uncertainty has a price tag. When the market turned against them, they weren't prepared, because deep down, they never believed in the trade to begin with. That's what makes those losses sting twice as much, because they were preventable. When you step back and let the market speak, you give yourself time to think clearly. You start seeing patterns form naturally. You start noticing when the price action aligns with the story on the tape. You get to watch without bias. That distance gives you clarity. But when you jump in during doubt, your perspective narrows. You only see what confirms your bias. That's why traders chase reversals too early or hold losing trades too long. They stop listening to the market and start trying to argue with it. There's something powerful about doing nothing when everyone else is doing something. It takes strength to sit out when the crowd is rushing in. But that's the kind of strength trading demands. The amateurs confuse stillness with inaction, but professionals know that waiting is an active choice. It's controlled observation. It's the difference between reacting to noise and responding to truth. The market doesn't whisper. It roars when it's ready. If you can't hear it clearly, that means it's not your turn yet. I remember times when I'd stare at the tape and feel completely lost. Prices jumping, patterns breaking, the usual rhythm gone. The younger version of me would have tried to outthink it, to find a reason to stay in the game. But experience taught me that confusion itself is a signal. If the market feels unclear, it's because the big players haven't made their move yet. They're waiting, positioning quietly, letting the small traders exhaust themselves. When that happens, the best move you can make is to step aside and protect your capital until the storm passes. Doubt also plays tricks on your psychology. It makes you question not just the market, but yourself. You start second, guessing your strategy, your system, your instincts. You tweak settings, jump between indicators, abandon your plan. That's dangerous, because it's not the system that's broken. It's your confidence that's shaken. And confidence doesn't return through action. It returns through clarity. The only way to get that clarity is to pause, breathe, and let the market define its next move. When you stop trading during doubt, you're not being passive. You're preserving your ammunition. Every trade costs you mental capital as well as financial capital. If you keep firing shots in foggy conditions, you'll have nothing left when the real target appears. That's why the pros trade less and watch more. They understand that capital preservation is a form of progress. Every dollar you don't lose today is a dollar that can work for you tomorrow. The undisciplined trader can't see that. He measures progress only in action, not in restraint. Letting the market speak also teaches humility. It reminds you that no one, no analyst, no algorithm, no trader ever truly controls the outcome. You can read signals, but you can't dictate direction. Your job is to listen, interpret, and respond. The market is the teacher, not the student. And when you're filled with doubt, that's the time to close your mouth and open your eyes. Watch the volume, the structure, the rhythm of price movement. Let the truth emerge from the tape instead of trying to carve it out of chaos. The traders who survive the longest are the ones who understand that missing trades isn't failure. The failure is refusing to wait for clarity. The market gives you moments of opportunity, and they stand out clearly when they come. They don't require force or guessing. They reveal themselves. But you'll only recognize them if you've trained yourself to pause during confusion. When in doubt, step back, protect your capital, and let the tape show you its story. A missed trade is cheaper than a forced trade. I learned that lesson long before I ever made a fortune in the market, and I paid for it with time, not money, which in this business is the best kind of tuition you can get. You see, every trader wants action. They sit in front of their screens, the tape moving, the candles forming, and they start feeling that itch. The urge to click the button, to be part of the move. But here's the truth. The market doesn't care about your boredom. It doesn't owe you a trade. The market will give you signals when it's ready, not when you are restless. So when you force a trade just to be in, you're gambling, not trading. And gambling, sooner or later, costs you everything. The temptation to trade for the sake of trading is one of the oldest traps on Wall Street. It's the silent killer of accounts, and it doesn't strike like a crash. It drains you slowly, trade by trade, as you keep trying to make something happen that isn't there. You look at a chart, convince yourself there's a setup forming, and enter half prepared. You justify it by saying, I'll manage the risk, or I just need a little movement. But deep down, you know it's not your setup. You know the tape isn't clean. You know the volume's not right. So why take it? Because patience feels uncomfortable. Because you think doing nothing means you're missing out. But you're not missing out. You're saving yourself from a bad trade. Think about it. A missed trade costs you nothing but an opportunity. A forced trade costs you real capital, real emotion, and real confidence. You lose once on the chart, and then you lose again in your head. And once your head's gone, the rest follows. Most traders don't blow their accounts because they don't know what to do. They blow them because they can't stand doing nothing. The real skill in speculation is waiting for the market to show its hand, waiting for confirmation, waiting for the odds to be in your favor. Every minute you spend out of the market waiting for a clean setup is an investment in your survival. In the previous video on how to trade consolidation zones, I told you that the best moves come after periods of stillness, after the market has coiled up, resting, waiting to break. The same principle applies here. The right trade reveals itself naturally when you've been patient enough to let the noise settle. You don't force it, you recognize it. The consolidation taught you to sit on your hands while others guessed the direction. That same discipline saves you from forcing trades in a choppy, uncertain market. When the tape is messy, you don't need to participate. You need to observe. You can't train the market to give you setups on your schedule. You can only train yourself to wait until it does. That's what separates the professional from the amateur. The amateur feels the need to do something. The professional feels the need to protect something. His capital, his edge, his mindset. Every time you take a trade outside your system, you dull your edge. You teach your brain that rules can be bent. And once you start bending rules, you stop trading and start reacting. The market will punish that every single time. I used to sit in the old bucket shops, watching the tape click across the wall, and I'd feel the same urge. I'd think, the market's moving, I should be in. But the moment I gave in to that thought, I paid for it. I learned that the hardest job of a trader isn't finding trades, it's rejecting bad ones. Most men can't do that. They see a small move and jump in, afraid to miss it. They don't realize that missing a trade never killed a trader, but but forcing one has ruined plenty. The tape doesn't care if you're on board. It will move with or without you. The question is, will you still have your capital when the next real move comes? Ask yourself, how many times have you taken a trade just because you hadn't traded in a while? How many times have you watched a clean setup come and gone, and then chased it late, thinking you were missing out? Every trader's done it. The pain of missing a move feels sharp in the moment, but the pain of losing on a bad entry lasts far longer. You can recover from missing a profit. You can't easily recover from losing discipline. The difference between good and great traders isn't the number of trades they take. It's the number of trades they don't. If the market is quiet, that's not a problem. It's information. It's telling you that the odds aren't clear, that the big money isn't moving yet. Your job is to wait for the footprints of the big players, not to guess where they'll step next. Forced trades usually happen in low volume, uncertain environments. The price moves a little. You think you see something, and before you know it, you're trapped in a whipsaw. The pros aren't trading those conditions. They're waiting for you to make that mistake so they can fade your move. There's another cost to forcing trades. One most traders don't notice right away. It drains your focus. Every unnecessary trade burns mental capital. It eats into the energy you should be saving for real opportunities. So when that perfect setup finally comes, you're too distracted or too beaten down to take it confidently. That's how the market wins twice. First, by taking your money on a bad trade, and second, by stealing your courage when it counts. Trading isn't a contest of who trades most. It's a contest of who trades best. The market doesn't pay you for activity. It pays you for accuracy. And accuracy comes from patience. Every tick you resist chasing, every fake breakout you sit out, every dull session you watch quietly. You're building the muscle of discipline. The missed trades are the tuition you pay for mastery. They're proof that you're learning what most traders never do. That silence is part of the process. So when you see the market move and you feel that rush in your gut, that sudden urgency to be in, pause. Ask yourself, is this my trade or just my boredom talking? Because boredom is expensive. It tricks you into believing the market owes you an opportunity when it doesn't. Remember this, a forced trade is like a leak in your boat. One may not sink you, but over time, the water adds up. The only way to stay afloat in this business is to trade less, wait longer, and act only when the market shows you its hand. Emotional trading is the fastest route to ruin. I've said that line to more traders than I can count, and every one of them nodded in agreement until the market tested them. Because it's one thing to know you shouldn't trade on emotion, and another to actually keep your head when your money is on the line. The market is a master at pulling those strings. It knows exactly how to make you doubt your plan, chase your losses, and throw logic out the window. But once emotion takes the wheel, reason gets left behind, and your account usually follows. You see, the market is built to provoke you. Every tick on that chart carries weight when you have money in the game. When the candles flash red, fear kicks in. When they flash green, greed takes over. And both emotions whisper the same lie. You have to do something right now. That's how traders end up pressing buttons they shouldn't, entering too early, exiting too late, or doubling down on bad trades. They forget that doing nothing is a position. The calm trader wins because he acts when the odds are right, not when his feelings are loud. I remember in my early days, I'd sit there watching the ticker tape roll, heart pounding, palms sweating, every move feeling personal. When I won, I felt like a genius. When I lost, I felt like a fool. That kind of thinking is poison. The market doesn't reward ego, it rewards discipline. Emotional traders live and die by every tick, but the professional knows that no single trade defines him. He's not married to any position. If the tape turns against him, he doesn't argue. He acts. He takes the loss and moves on. No explanations needed. Now, think about your own trades. How many times have you exited a position too soon because you were scared of giving back profits?
Yep,
Or held
fear.
on to a losing one because you couldn't stand to admit you were wrong? That's emotion talking. The charts don't change because you're afraid or hopeful. The market doesn't care how badly you want to be right. It only reacts to order, flow, and pressure. When you let your emotions dictate your trades, you're fighting the market with feelings instead of facts. And that's a fight you'll never win. Fear and greed are the twin thieves of every trading account. Fear keeps you from taking good trades. Greed keeps you in bad ones. Together, they turn a rational trader into a reckless one.
Look here,
Fear
see
whispers,
$4
"What if you
volume.
lose?" Greed
You
whispers,
can see that?
"What if you make more?" The professional
Look right here, guys. Look.
listens
See?
only to the tape. He has a plan before he ever enters a
Look
trade.
here, right here. You see the
Entry,
volume?
stop,
2 minutes.
target. He follows
It's
it,
4.
no matter what he
I
feels
said
in the moment.
reversal.
Because the moment you start making decisions based on emotion,
Look right here.
you've already
See?
lost
When I
control.
say that, right
In the
here.
previous video on how to trade
A lot of volume,
consolidation zones, I mentioned how the
but
market
not
tests
moving.
your patience before it rewards it.
Right here,
The
guys.
same principle applies here. Emotional trading usually begins in those quiet zones, when the market isn't
Right
moving
here, look.
and your mind starts inventing reasons to act. You mistake boredom for opportunity. Then the market moves slightly and emotion floods in. You chase a
Right,
breakout
look.
that isn't real, or you
Reversal.
panic out of a range that was perfectly normal. The same patience that kept you safe in those consolidation zones is what protects you here. The less emotion you bring to the tape, the clearer the picture becomes. The great traders aren't made
Right
by
here,
the
guys.
wins.
Look.
They're defined by how they handle their losses.
I can see it, right?
Anyone can stay calm when things are
Right
going
here.
right. But
Reversal.
when the
I
market
say that.
turns, when the stock gets hit, when the streak ends, that's when a trader's true nature shows.
Crazy, huh?
Most can't handle it. They take it
I can
personally.
see right here, guys.
They start seeing patterns
$4.
that aren't there, forcing trades to win back what they lost.
Right now,
They
482.
forget that every trade is just one in a series, one small part of a much bigger story. The trader who survives is the one who can lose without losing his head.
Okay, this one is
The
animal. This
game,
one
the less
here.
emotional you are, the more money you make.
Okay, FPPBT.
Because when you're
He
tired,
stopped me
you
out
can see clearly.
and it started to
You can
move.
wait for confirmation. You can read the tape.
Look at here, guys. Look at it.
But when you're emotional,
You can
the
see
chart
this right
becomes a
here.
mirror reflecting your fears. You see what you want to see.
This candle here stopped me out right here.
That's how you end up chasing green candles or holding red ones, thinking the market owes you a turn.
Look at
It
it.
does.
See, the market is crazy. Look here, guys. Look.
Ask
I
yourself
put down the
now,
stop right here.
do you trade what the market shows you or what you feel it should do? Most traders don't realize they're
87.
emotionally attached to their opinions. They'll
I
defend
put the
their
enter,
position
enter
because
87,
admitting they
87
were
right
wrong
here.
hurts more than taking a small loss.
Crazy, huh?
Pain
And then
and
start to
discomfort
move
is
higher.
part of the job.
That's
The
crazy,
quicker
guys.
you learn to accept it, the longer you'll
But
last
where I
in
got
this
in,
business.
I got in
Rewards
90.
Objectivity. The emotional trader might
I
get
got in
lucky for a
90.
while, but
And
luck
I put
doesn't
out very
spread.
low stop right here at 90 and very low
One of the
stop.
best ways to fight emotional trading
I get in right
is
here.
through structure. You
What
need
time?
rules that protect you from
What
mistakes.
time right here?
Before you enter any trade,
10,
know your entry,
11:51.
know your stop, and know your target. Then obey them. Don't move your stop just because you
11:51.
feel like the market might turn.
I got in right
Don't
here,
lose your
guys.
position hoping it will bounce.
Get in right
If your
here.
setup isn't there, walk away.
I put and then
The
he
only
stop.
way to
Look
stay
at it.
consistent
Look
is
at
to take
it.
emotion
And
out
then
of
it
the
start all the way
equation
up,
and
guys.
let your plan guide
This
you.
go to $1
The
again.
plan is your anchor when the waves get rough. There's also a simple truth that most traders ignore. Your mindset outside the market affects your mindset inside it. If you're trading tired, stressed, or desperate, emotion will find its way into your decisions. You can't separate your state of mind from your execution.
That's
That's
crazy.
why trading isn't just
The
about
market's
reading
crazy,
charts.
guys.
It's about reading yourself. Before you ever open a position, you have to check your emotional temperature. Are you calm? Are you patient? Are you focused on process instead of profit? Because if you're not, the market will expose it. Emotional trading often starts small. A little revenge trade here, a little hesitation there. You justify it by saying you'll get back in control later. But later never comes. Each emotional decision feeds the next until your account is half gone and your confidence is gone with it. The trader's downfall doesn't come from one big mistake.
Crazy,
It
huh?
comes
See
from a
volume.
thousand small ones.
When you look at the volume, you know what's going on, guys.
And the worst part,
Look at
you
this
don't even
one.
see it happen
Triangle.
until it's too late. If you want to survive in this business, you have to become a student of your own emotions. Learn how fear feels in your body. Learn how greed sounds in your mind. Because once you can recognize them, you can catch them before they act for you. The market's not the real enemy here. It's your reaction to it. Every successful trader learns to control that reaction, to keep his mind steady no matter what the tape says. Only then can he see the truth in front of him. Discipline is the trader's first line of defense. Without it, every other part of your trading, your strategy, your analysis, your instincts, means nothing. I've seen brilliant analysts go broke and average traders grow rich, and the difference between them wasn't intelligence, it was discipline. The market doesn't care how smart you are. It doesn't care about your opinions or predictions. It only cares about how you act when the tape moves against you, when your emotions flare, when every part of you wants to break your own rules. That's when discipline either saves you or destroys you. Discipline in trading isn't about perfection. It's about consistency. It's doing the right thing again and again, even when it's boring, even when it feels unnecessary. It's cutting losses without hesitation, waiting for confirmation before you enter, and sitting on your hands when the setup isn't there. It's not glamorous work. It's not exciting. But it's what keeps your account alive long enough for opportunity to arrive. The man who trades with discipline will outlast the one who trades with emotion every single time. Because in the end, survival is the real edge. When I started out, I thought trading was about finding secret information or the perfect system. I spent years chasing indicators, studying patterns, looking for some magic formula. But the longer I stayed in the market, the clearer it became. There is no secret. A breakout with power and force, and it must, without exception, be accompanied by a dramatic and significant increase in the volume of trading. This is the market's own confirmation that the move is genuine and is being sponsored by the smart money. To buy before this pivotal point is to act on hope. To buy after this pivotal point has been confirmed by the tape is to act on evidence. The entire science of speculation can be reduced to this simple distinction. The professional waits for the evidence. He may have to wait for days, for weeks, or even for months. It does not matter. He has the discipline to sit with his capital and his peace of mind intact until the one single high-probability moment presents itself. The market is not a continuous performance. It is a series of rare and valuable opportunities. The speculator's job is to be ready for them. To act without a clear signal from the tape is to be a sucker, providing your capital for the benefit of those who are patient enough to wait for the proper time. 8. Cash is a position. The amateur speculator believes that to be in the market is to be a speculator, and to be out of the market is to be a failure. He feels a constant nervous itch to be invested, to have a position on. To be in cash to him feels like an admission of defeat, a missed opportunity. This is a profound and costly psychological error. The master speculator understands a truth that is invisible to the novice. The cash position is often the most strategic, the most powerful, and the most profitable position of all. To be in cash is not to be out of the game. It is to be a king in reserve, waiting for the decisive moment to enter the battle.
Delayed if you want to get access.
The man who is in cash possesses an asset of incalculable value, a clear and objective mind. He is not emotionally entangled in any particular stock. He is not being whipsawed by the market's minor fluctuations. He is not suffering from the mental exhaustion that comes from a series of small, frustrating losses.
And again, I'll see
He
you
can
guys
sit
out
and
there.
observe the market with the cool detachment of a scientist. He can see the great primary trends forming without the distorting lens of his own hopes and fears. His judgment is sound. His mind is at peace. The man who is always in the market, by contrast, loses his perspective.
Alright, this is a VBS setup right here,
He is
guys.
clouded by his last trade. He is either overconfident from a small win or fearful from a small loss. He cannot see the forest for the trees. There are long periods in the market when the conditions are not clear, when the tape is telling a story of confusion and indecision. These are the treacherous sideways markets. The professional speculator knows that to trade in such a market is to engage in a low probability gamble. His response is simple. He does nothing. He sells his positions, converts his assets to cash, and he waits. He preserves his capital, and more importantly, he preserves his mental and emotional energy. He knows that his job during these times is to study the market, not to trade it. To be in cash is to be the master of your own destiny. You are not at the mercy of a sudden overnight news event. You are not a prisoner of your own positions. You are a free agent with your capital intact, ready to strike with overwhelming force when the one true and unmistakable opportunity finally presents itself. 9. Never trust tips or other people's opinions. The speculator who would succeed
Alright, VBS setup, guys.
must be a
VBS
lone
setup.
wolf, doing his own thinking, forming his own conclusions, and acting upon his own judgment. The moment he allows the opinion of another man to influence his decisions is the moment he has surrendered his own mind, and his capital is sure to follow.
Here
The
the
world
plan.
of
You
Wall
see
Street is
here?
a vast and noisy echo
Because so
chamber
squeeze right here.
of
It's squeeze, guys.
of so-called inside information.
Okay?
This is the bait.
Here the VWAP. Under here you get out.
Intellectual
You can
laziness
jump in right
is a
here.
shortcut to easy
Watching this one, maybe you can pull back over here.
He does not stop to ask the
You can
most
pull back over
logical
here.
questions.
And then the second one you can jump in. This is 11 o'clock. Powerland right here.
He does not see that a genuine tip is the
VBS setup, guy. Power lunch
and
right
the
here.
vast majority of what he hears is either a guess, a hope, or a deliberate piece of manipulative propaganda. To act on a tip is to make a trade for which you do not understand the premise. You do not know the real reason for
VBS
buying,
setup right here.
and therefore you will never know the real reason for selling. You are a blind man being led by another, and both are destined for the ditch. Livermore learned this lesson in the most brutal way possible. In the great cotton debacle, where he lost a fortune by subordinating his own judgment to that of the expert Percy Thomas. He had seen the cell signal on the tape. His own proven method was screaming at him to get out, but he listened to the persuasive, hopeful words of another man. It was a mistake that cost him everything. From that day forward, the rule was absolute. He did his own work. He studied his own charts. He read his own tape. His mind was a locked room, and the opinions of other men were not granted entry. The speculator must learn that no man can make a great fortune by having another man tell him what to do. The thinking must be his own. The decisions must be his own. And the responsibility for both the profits and the losses must be his own. 10. Patience is protection. The virtue of patience is not, as the amateur believes, a passive quality, It is an active and powerful form of defense. It is the speculator's primary shield against the two things that are most certain to destroy him: his own emotional impulses and the market's many deceptions. Patience is the discipline to wait, motionless, for the one true high-probability setup. It is the refusal to be lured into the market by the siren song of small, meaningless fluctuations. It is the wisdom to know that the money is made not in the trading, but in the waiting. Patience is the protection against the whipsaw of a sideways market. The impatient trader is chopped to pieces, his capital bled dry by 1,000 small cuts. The patient trader stands aside in cash, his capital preserved, and waits for the trend to declare itself. Patience is the protection against chasing a stock that has already had a great and powerful advance. The impatient trader, driven by a fear of missing out, will rush in at the top, just as the smart money is beginning to sell. The patient trader will let the stock go, knowing that to buy late is to buy wrong. He understands a simple truth. The market is a continuous parade of opportunities. To miss one is of no consequence, for another will soon come along. There is no need to be in every move. There is only a need to be in the right moves. Patience is also the courage to sit tight with a winning position. It is the discipline to not be shaken out by the normal, healthy reactions that are a part of every great trend. It is the fortitude to let a profit run, to allow a 10-point gain to become a 100-point gain. The speculator in the end is paid for his patience. He is paid for his patience in waiting for the correct entry. And he is paid for his patience in waiting for the correct exit. Every other action in between is a potential source of loss. 11th, the market is always right. A speculator is a man who deals in opinions. He forms an opinion based on his study about the future direction of a stock or the market. But he must never, for a single moment, forget this one supreme and humbling truth. His opinion is worthless until it is confirmed by the market itself. The ticker tape is the final arbiter. It is the Supreme Court. Its verdict is the only one that matters. The speculator who begins to believe that his own opinion is more important than the market's action is a speculator who is on the verge of a great and devastating ruin. This is the very essence of the ego trap. The amateur, when a trade goes against him, is often heard to say, "The market is wrong. This stock should be going up." This is a statement
Pumping
of
down right there.
dangerous insanity. The market can never be wrong. It is the sum of all forces, all knowledge, and all opinions. It simply is. The speculator's opinion, on the other hand, can be, and very often is, wrong. The entire business of risk management is built upon this simple acknowledgement of one's own fallibility. The stop loss is the practical mechanism for enforcing this principle. It is the pre-committed decision to accept the market's verdict without argument. When a stock moves against a speculator and hits his stop, the market is saying, "Your opinion is wrong." The speculator's only sane response is to say, "I accept your verdict," and to close the position. To argue with the tape, to hold a losing position in the face of the market's contrary evidence, is the act of a man whose pride has become more important to him than his capital. And the market has a way of taking both from such a man. 12th, control emotions. This is the final and the all-encompassing law. It is the one principle that makes all the other 11 possible. The speculator who has not first learned to control himself can never hope to control his account. The great battle is not fought on the exchange. It is fought within the mind. The market is a machine that is designed to exploit the most powerful and primitive of human emotions. It tempts a man with greed. It paralyzes him with fear. It deludes him with hope. It inflames him with ego. These are the great enemies of the speculator. The entire set of rules and principles that Livermore developed was, in the final analysis, a system for the management and control of these emotions. It was a scientific fortress, built to protect his rational, analytical mind from the destructive chaos of his own human nature. The stop loss is a rule against hope. The practice of patience is a rule against greed and impatience. The principle of following the trend is a rule against ego. Each rule is a specific and targeted defense against a specific emotional weakness. The speculator who would succeed must become a cold and detached operator. He must learn to view the market not as an exciting casino or a personal antagonist, but as a series of impersonal mathematical problems to be solved. He must achieve a state of mind where he can take a loss without flinching and a great profit without gloating. He must be a scientist, an observer of facts, not a participant in a great emotional drama. This is the hardest work of all. It is a lifelong and never-ending battle against the powerful currents of one's own inner world. But it is the one battle that must be won. For the speculator who has achieved a state of perfect emotional control is the speculator who has at last become invincible.
When I was 12 years old, my friends all were growing faster than me. My mom took me to a growth specialist. They said you weren't eating properly. The options were either growth hormone injections or conventional nutrition shakes. We had this book that had a page on the ingredients.
Have you ever watched a promising trade turn into a devastating loss that wiped out weeks or even months of profits? That sickening feeling in your stomach as you watch your account balance plummet, hoping desperately that the market will turn around, only to see it fall even further. If you've been trading for any length of time, I'm willing to bet you've experienced this gut-wrenching scenario more than once. What if I told you that one of history's most legendary traders discovered the solution to this problem nearly a century ago? A solution so powerful yet so simple that it could transform your trading results almost overnight? But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Today, we're diving deep into the hidden wisdom of Jesse Livermore, arguably the greatest trader who ever lived. A man who made and lost several fortunes throughout his remarkable career, at one point amassing the equivalent of billions in today's dollars. But Livermore's true legacy wasn't his spectacular gains. It was his revolutionary approach to protecting capital through strategic stop-loss placement. Has this ever happened to you? You enter a trade with complete conviction, only to panic and exit at the worst possible moment? Or perhaps you've held on to losing positions far too long, watching helplessly as small, manageable losses snowballed into account-destroying disasters. You're not alone. These psychological traps have ensnared even the most experienced traders. The only thing that saves a man from bankruptcy are his stop-loss orders. These words, spoken by Livermore himself, came at an enormous price. Before developing his systematic approach to risk management, he experienced the devastating consequences of trading without proper protection, losing his entire fortune multiple times. Through these painful experiences, Livermore discovered 5 secret stop-loss rules that would forever change how he approached the markets.
You say pull back right here, let
this video,
more class.
because what
Watch out right here.
might surprise you.
See, break 245 now.
Stop-loss strategies you've heard before. They're sophisticated.
Nothing's sure, okay?
Techniques that
This is a
address
possibility,
technical and
not-
psychological
Nothing
aspects of
perfect,
trading.
okay? So
Approaches that remain astonishingly relevant in today's fast-paced markets. Now imagine being able to enter every trade with complete confidence, knowing exactly where to place your stops to protect your capital while giving your positions room to breathe. Picture yourself
your
trading
stop down here,
with the
okay?
same disciplined approach that allowed Livermore
Over here,
to
your
profit
stop down here.
spectacularly during some of history's most volatile markets, including the infamous crash of 1929, when most investors were financially ruined. The first of these 5 revolutionary stop-loss rules challenges conventional wisdom in a way that might initially make you uncomfortable, but once implemented, The first of these 5 revolutionary stop-loss rules
Still not breakout yet.
conventional wisdom in a way that might initially make you uncomfortable, but once implemented, it will transform how you approach every trade. If you're serious about mastering your trading psychology like Livermore did, hit that subscribe button too. Join our community of dedicated traders. I share these timeless market insights regularly that you won't find in typical trading courses. But before we can truly grasp Livermore's genius, we need to understand the foundation upon which his entire methodology was built: market structure. You see, Livermore didn't view charts as mere squiggly lines on a screen. He saw them as living, breathing representations of human psychology, a battlefield where fear and greed wage constant war. Through countless hours of meticulous observation, Livermore developed an almost sixth sense for identifying key support and resistance levels, what he called pivot points. These weren't arbitrary lines drawn at round numbers or percentage moves. They were precise psychological battlegrounds where smart money repeatedly showed its hand. What separated Livermore from his contemporaries was his revelation that stop losses should never be placed according to what you can afford to lose. This common mindset trap, "I'll risk 2% on this trade," completely ignores what the market is actually telling you. Instead, Livermore insisted that stops must be placed logically, based on where price action itself suggests your trade idea is wrong. This brings us to his first and perhaps most controversial rule: never average down on losing positions. I can almost hear some of you objecting. But what about dollar cost averaging? What about buying the dip? These popular strategies directly contradict. Livermore's wisdom and the consequences of ignoring his first rule have been the undoing of countless trading accounts. The hidden truth behind averaging down is that it's not a strategy, it's a psychological crutch. When we add to losing positions, we're not making a rational decision based on market evidence. We're making an emotional one based on our unwillingness to accept that our initial analysis might be wrong. Livermore called this dangerous practice the quickest way to the poorhouse, after witnessing it destroy the fortunes of many of his contemporaries. Think about the profound mindset shift this requires.
These 100% grass-fed beef sticks from Paleo Valley are 36 for just $36 right now. So before you go and buy them, here are 5 reasons I replaced processed snacks with these. Number 1, the ingredients. There's 100% grass-fed beef from American family farms and organic spices, which makes these sticks incredibly flavorful while keeping things clean. Number 2, they're naturally fermented, which creates a great flavor, but without the preservatives like encapsulated lactic or citric acid found in all the other meat sticks. Number 3, they're perfect for when you're trying to cut back on processed carb-heavy snacks, but still want something satisfying and delicious. Number 4, they're super convenient. I keep them in my bag, the pantry, my desk drawer, and I send them off to school at my go. They're a great protein-rich snack that won't hinder my health goals. And number 5, they're from Paleo Valley, which means everything is well-sourced, 100% grass-fed, grain-free, gluten-free, soy-free, 0 grams of refined sugar, and absolutely no seed oils. Like I said, they're 36 for $36 right now, so go and check them out.
Most traders enter the market with their ego leading the way. They become emotionally attached to their positions, their analysis, their beliefs about where the market should go. But Livermore understood that the market doesn't care about your opinions or desires. It moves according to its own internal logic, and your only path to success lies in aligning yourself with that reality rather than fighting against it. Instead of averaging down, Livermore taught a revolutionary approach. Cut your losses quickly with a predetermined stop loss, preserve your capital, and reassess. This isn't just a trading technique, it's a profound...
Look at crazy guy, look at it. Need volume. This one have volume. It's rate 245 right away.
The most valuable skill on any journey toward mastery. Now, I want to go even deeper into Livermore's second rule, which reveals how he precisely determined where to place these crucial stop-loss orders, a technique so powerful that it allowed him to enter positions positions with maximum confidence while keeping his risk precisely defined. If you've ever struggled with the emotional challenge of cutting losses, write in the comments, protect capital first. This simple mantra transformed Livermore's trading career. Livermore's second rule revolves around what he called pivot points, a concept that would revolutionize how traders understand.
Buy a step in, guy.
These pivot points are
Right here, you see pullback?
on a chart. They represent
That's what I draw right here.
psychological
See, I
battlegrounds
say
where
pullback,
the market
and over
has
here,
repeatedly shown its
the
hand.
VBA setup,
They're the footprints
pullback,
of institutional money, the
all the way, right?
of where the
I say right here,
is
look,
establishing
pullback.
positions. When Livermore studied charts, he looked
See?
for these significant
I say
price
support
levels
right
where
here.
the market demonstrated
Try to
key
break out.
support or resistance, areas where
Possibility
prices
right
rose
there.
multiple times, or where
Sometimes stuck right there, 245, cannot break, and pull all the way. Look at that guy.
Market psychology.
What did he say?
The collective mindset of all participants. The
What did he say?
brilliance of
What did I
Livermore's
say,
second
guy?
rule
What do I
lies
say?
in its elegant simplicity.
You see right there? Exactly, guy. Let's see what's going on. Let the market tell you what to do. That's a fake breakout right there. Be careful. To try to short right there. 245. That's crazy. It's almost 391 million shares today. Come on. Volume pickup, not good. The resistance so strong, 245. I need a lot of work, guy. Why 245? Let me tell you why. Okay, right here, too much resistance up here. That's all. This is the backside. I don't like backside. That's all. Too much resistance. You don't go nowhere. Maybe stop somewhere here, you know. You stop somewhere here. That's why I don't like backside. Over here, too much resistance up here. Here my drawing, see? I say right here, be careful, no good. Over here, too much resistance. Try right there, but be careful up here, okay? You see the bottom look good? Okay, I say pullback right here. Look at pullback. Exactly. Support right here. Under here, you need to get out. This can go all the way up here. Resistance. A lot of resistance up here, guy. Let's see what's going on. Maybe go down all the way here and start to curve back down. Let's see. If it breaks right here, A flush setup. You see the moon can go higher, that's all. Hold it right now, guys. Hold it. See the moon. Crazy, huh? Exactly, guy. Exactly. Crazy, huh? Good alert, right, guy? I say that. Exactly, guy. Exactly. Look at that. What's my deal? I say pull back right here, and then boom. Be careful up here, that's all.
ACDC. HRZN. HRZN.
Open. Break it. Yes, look
Hey
good.
traders, awesome to see you all here. Again, thanks for joining. Just an important announcement, this stream here is delayed. If you want to get access to the live features, so the live stream, the live commentary, access to our private Discord room chat, then use the link that we have in the description just under this video, guys. And also, I would like to ask you all kindly to hit the like button, subscribe to the channel if you haven't done
Watch
that
out
already.
right here. It's short
Yeah,
squeeze
see
right
you guys
now.
out there. Thank you.
Beautiful. It's hot right now. Cmbm hot right now. Call exactly. You can watch the video again. You will see it exactly. I see the pullback right here. 220, 230. You can make a couple cents right there. You see right there. Over here, up here, you see the pullback. Okay. Let me draw a line. You will see it. So. You see right there, you pull back already. Okay. Here the volume. I don't like the volume. When you see this volume, this might be go all the way to $3, right? But no. That's, you see the reversal right here. You see right here? Line right there. Let's see the bill more plus. If not, this is the backside, okay? Right here. 280. You see the ball plot, if ball plot rate, go higher, if not, all the way down. I call exactly right here, pullback. Ball plus or no? If no ball plot at resistance, that's reversal, that's done. You see right there, guy? It done. It done, guy. I say be careful up here. Put down too much. Short right there, guy. That's short right there. That's short right there. Okay. Let's see 10 minutes. 10 minutes. 2 days. Let's see. You guys see right here? A lot of resistance up here, right? This one, if this one break right here, you see the moon. If not, pull all the way back down here. So. What do I say? I don't like the volume right here, guy. Classic, right? Classic. Same as this one. Look here, volume right here. You see that? Volume right here. Same thing. every day, guys. You see bottom right here? Reversal, right? This all the way here, guys, look. I say right there, see, be careful, look, reversal. See right here, bottom? I don't like it, reversal. But this one good call. When it right here, I see right there, I say this one can pull back right here, resistant. Right here, resistant. Look, it touched right there real fast. It do real fast, guys. And over here, I say pull back right here. What the video? When it right here, I already call right here, start to go down. What's the video? When it right here. When you watch the video right here, I say start to go down. Yep, right here, I say start to go down. No, right here. That's crazy, guys. The market is crazy. You have to wait and see.
CYCE. Cmbm. Elisa. Elisa. Cmbm. 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 CPR. CYC. CBR. 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 RNGS.
Crazy, huh? Pull back, curl all the way up. Crazy. Just like that. Whoa. Okay, see that? When they break right there, you see the moon. That's crazy, guy. This is a good call. Power lung breakout right there, guy. It's so squeeze classic. That's a classic right there, guy. Crazy, huh? That's crazy. That's crazy. Look at that. That's a good one. That's a good breakout right there. Right here. That's the plane right here. You see right here? Pull back. Be careful. If this one break here, it go down. But the short got squeezed. right here, break right here, A plus setup right here. Boom. See, right here, I do exactly, say this one exactly, pull back, open, up, pull, squeeze. That's classic, guy. It's a classic, guy. I alert right there, VBS setup. VBS setup is here. Man, I say pull back. Support right here. Break the support. Pull back right here. Ball flat, boom, gone. Right there. Be careful, reversal right here, and then boom, crazy. How high can it go? Got no idea, okay? How high can it go? Got no idea. Got no idea, guys. $5? Don't know. Right there. 4 something, 5. Break. Yeah, 360. 360. It breaks 360 all the way to $4. If not, call back down.
Hey traders, awesome to see you all here. Again, thanks for joining. Just an important announcement, this stream here is delayed. If you want to get access to the live features, so the live stream, the live commentary, access to our private Discord room chat, then use the link that we have in the description just under this video, guys. And also, I would like to ask you all kindly to hit the like button, subscribe to the channel if you haven't done that already. And again, I'll see you guys out there. Thank you.
Whoa. When it hits 360, it goes down. 360. Hold it again. Crazy hold it, guys. Right now the salt got squeezed right now. Salt burned down right now. Okay, you can hear, you see here? Look, I do light train right here. I say right here, be careful. Look.
You do not know the real reason.
BBA set up right here.
And therefore you will never know the real reason for suffering.
Okay.
You are a blind man being led by another in both the destiny.
I said this one right here
Livermore learned this lesson in the most
can pull back.
in the great cotton debacle where
And then they pull back right here. Look at pull back right here. See that guy? I draw a line. Pull back.
These were. I share these timeless.
I say waiting right there. Can break or not? Okay. Look here. Let the market tell you what to do. Break right there. Break out right there. Be careful. See? Right? Break right there. Be careful right here. Start to pull down right here. See? 280. See straight up? Yeah. See pull back? Right here. Right there, see? On the video. Can you see that? I pull back. I say, be careful. Right? Look here. No, not yet. And then I draw the line right here. I say this way, maybe the ball plus. You need to break 280. Right? Need to break 280, look. Boom, right there, 280. When you break 280, Boom, see? That's a good classic guy. That's a cute one. Not bad, guy. Classic guy. I got look right there. VBS it up. VBS it up in here. Man. I say pull back. Support right here. Break the support. Pull back right here. More flat. More down.
Please leave your message for 4695.
Be careful when you look. Still light right now, see guy. I draw a line 360. Okay, let's watch see got one going on 360. I don't know, okay? I don't know, but 360, be careful. 360, be careful. You never know when it open. Whoa, VB. Everything go up, guys. Look at this one. This one all the way to $9 right there. See triangle. Crazy. Okay, this one squeeze right now. This one hold right here, squeeze. Double top 150. A lot, guy, a lot of power lunch. Wait for this one right here. This one dead. YYN. This one a couple of days ago go to right there. For 6 go to $11. Right now $2. $2. I have a couple share. That's crazy. Yep, 260, done. You guys see that? 360, done. If this one break 360, you see another squeeze. Be careful at 360, right? Don't last short right here right now. But the buyer step in, is squeeze again. If not, the short in control. The short in control, that's all. The market reversal right now. Nvidia going down. This one's going down. It's all the way here 250. Shit. How can it, when can it go to 250? Allah pump and dump. This one dumb and dumb. This one pump and dump too. The market is scam, guys. All market is scam. BM. Yep, start to dump right there. I say 250 right there, okay. And I'm not joking. Right here, I say. I say right here, be careful. Okay, let's see what I say.
Yeah, 360.
Yep, I say 260.
360.
I say 360, right there, I draw a line. Make sense?
It break 360 all the way to $4. If not, call it back down.
Hey traders, awesome to see you all here. And thanks
See,
for
I draw a line right there.
important announcement. This trade here is delayed if you want to get access to the live features. So the live
This is a live stream a couple of minutes ago. I draw a line right there, 360. Look right here, coming down. Not bad, guy. Not bad. Let it run, guy. Let it run. If you know how to read technical, it's safe for you, guy. Okay. All right, first, use your eye to see technical. All right. If you don't know technical, you cannot see nothing, okay? First of all, you see your technical. Second, discipline. And plan your trade. Know what price your stop. You know what price you stop, okay? And
Cmbm.
3, watching the volume. Volume, the VWAP, and the time. We call it power lunch. All kind of thing, guy. A lot of things, okay? That's it. Plan your trade. see, I know 360. And I say, be careful, 360. You can see some right there, 360. The whole day. Right here, when it hit right here, I say ball plus. Break the ball plus. At 280, pull back, ball plus, another ball plus. Right here. Can you see that? That's all. See right here, ball plus, right here, 1, 2. I say break right here, be careful right here. When it break right there, boom. Right here, see? Right now, see what's going on, alright? This is the back side right now. You have to jump out all, and when you buy back, we'll buy back, okay? Let me see right here. Easy to say, right? But right there, look at it curve back up right there, okay? Look at that. The salt and the water, okay? The salt is underwater, all right? So right now it's trying to be right here. It may be pulled all the way back down here. But over here, you already sold over here, sell over here. And then you buy back right here, okay? You buy back right there. When you buy right there, you stop under here. That's your stop. When you're in here, you stop right here. For example, right now, you in right here, you in right here, you in right here, you stop down here, you stop down here. Look like football, guy. You defend and you offend. Let's see. It's not set up right now. It's not the setup. $3 support. Buy a step in $3. It's all psychology, guy. All psychology. Buy a step in at 3. Hold on 3 right there. $3 support, resistance 360. Let's see what it does. Right here, $3, okay? $3 support, 360 resistance. Okay, right there. Let's see what's going on. It jump before 3, you need to get out all. Try it, try 1/10 share only. Try small size and see it work or not. Okay, you jump in 360, 365, in 350, 355 you get out if you're wrong, okay? So you jump in right here, if you jump here, you're wrong, you get out here. Over here, it start to curve back up, you can jump some, but you're wrong, you get out right here. That's it. Yep, you can do some right here. The volume look good. Okay, this is an old one, okay, this is old, right? Forget about it. This one is new plan right here. New plan, guy. Okay, new plan. All right, right now 360, buy step in, 360. Let's see a bear flash or no, okay? 360 right here, $3. You can jump in right here. You can it got in 360. 299, you need to get out. You know when you get out, you accept it when you're wrong. But when you go all the way here, double top. If that debut in the ball plus, good. If not, you get out. That's it. Get out here. Get out under here. Depend on what your price. If you got in 330, you get out at 299. If you get in, and then you can sell some 250, 240 or something, 245. You sell half and half. You sell half and half and see what's going on. When it go to 260, you fear. Your emotional got to be fear, okay? You fear it go down. That's why you hit the bell. You question mark why you fear. Use your eye. Let your eye control it. Let your eye control it, that's all. Your eye see it support, resistance 360. You can sell right there. If not, you hold on. And then you can add on more right here, 365. When you go up, you add on. When you go down, you get out. You never ebb it down. Never ebb it down, okay? No ebb it down, okay? Never. Never, never, never. Never ebb it down.
Hey traders, awesome to see you all here. Again, thanks for joining. Just an important announcement, this stream here is delayed. If you want to get access to the live features, so the live stream, the live commentary, access to our private Discord room chat, then use the link that we have in the description just under this video, guys. And also, I would like to ask you all,
Let's see what's going on.
subscribe to the channel if you haven't done that already.
Oh man, 330 resistant. A lot of pressure at 330. Alright, dumb. Bear plus. 299, dumb all the way down to 2. Look at here, 100,000 sale right here, 311 sale right there. Crazy. Where the money come from, guys? Crazy. A lot of money. Almost $500,000. Eesh. Where the money come from? Đó. One minute là nó mua cả 300-400 triệu, 300-400 ngàn luôn. Tiền không là tiền, ok. Hold it. All right, so 330 resistance, support $3, 360 resistance. So they got 3 resistance right there. That's the market tell me like that. Under here, you need to get out all of them. All right, get out all right here. Get out all. This one dumb right here, crazy. Everything go up, everything go down. Everything go down, slowly go up.
Cmbm.
Place your stop losses just beyond these pivot points. Why? Because when price breaks through a pivot point, it often signals a fundamental change in market direction. The underlying narrative has shifted. The market is telling you, with clarity and conviction, that your analysis is likely incorrect. This approach creates a remarkable harmony between risk management and market reality. Rather than setting stops based on what you're willing to lose, you're setting them based on where the market itself suggests your trade idea is invalid. It's a profound shift from ego-driven trading to evidence-based decision-making. But Livermore's journey toward mastery didn't stop there. His third rule introduced a dimension many traders completely overlook: time. In his meticulous observation of market behavior, Livermore discovered a hidden truth that contradicted conventional wisdom. Time is often more important than price. Time is more important than price. When time is up, close the trade. This statement encapsulates one of Livermore's most powerful insights. He understood that markets move in rhythms and cycles. If a position doesn't move in your favor within a reasonable time frame, it's not merely stagnating, it's actively.
Getting all your daily nutrients is hard work, but nutrition gaps in your diet are inevitable. But there's an easier way to fill them. Meet Grooms. G-R-O-O-N-S. The snackable, packable wellness gummy that packs the comprehensive nutrition you need. It is this guy right here. Grooms loads a complete serving of fruits, veggies, adaptogens, vitamins, minerals.
Telling you something. Think about the transformation this creates in your trading psychology. Most traders become prisoners of hope. watching their capital sit idle in positions that show no momentum, all while better opportunities pass them by. They fall victim to the sunk cost fallacy. I've already invested so much time in this trade. Surely it will turn around eventually. Livermore's time-based stop loss liberates
It looked like bear flash.
by establishing a clear time frame for each trade. To prove itself, you prevent capital from being tied up in positions that lack conviction.
This is the back
Retain
side.
the agility to redirect
See what's going
resources
on.
toward more promising opportunities. You respect the market's message rather than imposing your will upon it. This approach requires a level of self-awareness that transcends typical trading education. It demands that
Backside,
you release your
guy.
attachment to
Backside.
being right and embrace the fluidity of market movements. The most successful traders aren't those who cling stubbornly to their positions. They're the ones who adapt swiftly to changing conditions. Let's now examine
There's a big
how
backside
Livermore's
right there.
understanding of trading psychology formed the foundation for his next revolutionary
Break
stop-loss technique.
330,
One
break
that
it.
addresses perhaps the greatest challenge all traders face.
When they break
If you've
330, you
discovered
see the
importance
moon.
of timing in your own trading journey, type time equals opportunity in the comments below.
330.
The real battleground of trading isn't found on charts or in economic
Hold it. Oh man, that's
it's fought in the
crazy.
shadowy landscape.
332. Hold it.
Livermore recognized this profound truth long before modern psychology had a name for it. He observed that most traders fail not because of poor strategy, but because of psychological weaknesses that sabotage even the most
Crazy,
brilliant
huh?
analysis.
332.
The market is never wrong. Opinions often are.
If this one down
as
here,
famously remarked. This
Done.
simple statement
If this
reveals
one
the
break right here and go all the way up here,
traders face,
double top,
separating our identity from our market.
we're in the ball flat, and break
When
ball
we
flat.
get emotional
See?
attachment
Depend
to
on.
analysis, we
Depend on the
resist
market, what
evidence
he
that
say.
contradicts it.
But
We
now it look like it tried to hold right
Move
here.
stop losses further away,
When it opened
rather than
lower,
accepting that our
going
initial
down,
judgment was flawed.
It opened higher,
This
it
type
goes
of
straight
trading
up.
wisdom has transformed
Got
my own
squeezed.
approach to the markets, and I'd love to continue sharing these powerful strategies with you. Hit subscribe
So
now
fun,
to
guys,
make
so
sure
fun.
you don't miss any future videos on these hidden trading principles. This cognitive blind spot represents perhaps the greatest obstacle on the path to trading mastery. Our minds are naturally wired to seek confirmation of our existing beliefs while dismissing contradictory evidence, what psychologists today call confirmation bias. Livermore witnessed this pattern of self-deception destroy countless trading careers, including his own during his early years. His revelation was that successful trading requires a complete mindset transformation. Rather than struggling against our psychological limitations, Livermore developed a framework that bypassed them entirely. His approach removed emotion from the equation by establishing rules that must be followed without exception, regardless of how strong one's conviction might be. Think about the liberation this creates. By committing to predetermined rules for stop-loss placement and management, you're no longer at the mercy of moment-to-moment emotional reactions. You're no longer tempted to give the trade more room when it moves against you, or to exit prematurely when anxiety strikes. The decisions have already been made. All that remains is disciplined execution. This brings us to Livermore's fourth rule, which addresses one of trading's most bittersweet challenges, managing winning positions. His trailing stop technique represents perhaps the most elegant solution to the age-old dilemma. Should I take profits now, or let this winner run? As a position moved favorably, Livermore systematically moved his stop-loss to lock in profits while giving the trade room to develop further. But unlike modern traders who often use arbitrary percentages to trail their stops, Livermore's approach remained firmly grounded in market structure. He moved his stops to significant pivot points that the market itself had established, allowing the trade to breathe while still protecting his accumulated gains. The psychological advantage of this approach is immense. Most traders experience almost as much anxiety with winning positions as they do with losers. They're haunted by memories of watching paper profits evaporate, leading to premature exits that cap potential returns.
My honest review on this natural remedies book after having it for a month. Look at this blood sugar page. It got this simple smoothie, coconut milk, cinnamon, flax seeds, banana, and ice. I make it in 2 minutes, and it helps balance my...
Livermore's trailing stock methodology creates the mental space to let winners truly blossom into the outsized returns that define exceptional trading careers. Behind the scenes of this technique lies a profound philosophical shift. Rather than trying to predict exactly how far a move will go, an exercise in futility, Livermore let the market itself reveal its intentions. He recognized that his role was not to impose his expectations on the market, but to align himself with its unfolding reality. Let's explore how Livermore applied these principles during some of history's most volatile market conditions, creating case studies that reveal the true power of his approach. If you've experienced the challenge of letting winners run without giving back too much profit, comment "trail with structure" below. Theory becomes most powerful when we can see it applied to real market conditions. Let's look at perhaps the most dramatic example in financial history, the infamous crash of 1929, when most investors were caught completely off guard, watching in horror as their life savings evaporated. Livermore was not only protected, he profited spectacularly. The market had been giving warning signals for months, but most traders were blinded by the euphoria of the roaring 20s bull market. Livermore, however, noticed the divergence between price action and underlying market health. As the market began to wobble in early September 1929, he placed his stops below critical support levels that had formed during recent consolidation patterns. When those levels broke with increasing downside momentum, his stops were triggered automatically. But Livermore didn't merely exit his long positions, he reversed course entirely, establishing short positions with the same disciplined stop-loss methodology. As the market collapsed in October, these positions generated profits that would be worth billions in today's dollars. This historical example reveals the transformational impact of proper stop-loss placement. While others were paralyzed by disbelief,
I see
or
$4,
hope that
huh?
the market would recover, Livermore's predefined rules
$4 guy.
removed emotional decision-making from the equation. The market spoke, his stops executed, and he aligned himself with the new reality rather than fighting against it. The journey toward trading mastery requires this level of detachment, the ability to separate market reality from our desires or expectations. Livermore's approach wasn't about predicting the crash. It was about responding appropriately when market structure changed, signaling that his previous analysis was no longer valid. Now let's explore Livermore's fifth and perhaps most sophisticated stop-loss rule, the volume-based approach. While price movements tell you what the market is doing, volume reveals the conviction behind those. Moves, the hidden truth about whether large players are accumulating or distributing positions. Livermore discovered that unusual volume often precedes significant price movements. He paid particular attention to two critical scenarios. First, when a position was moving in his favor but with diminishing volume, he recognized this as a warning sign of potential weakness or exhaustion. Second, when a position moved against him with increasing volume, he saw this as powerful evidence that his analysis might be wrong. In either scenario, Livermore would tighten his stops or exit entirely. He understood that volume represents the footprints of institutional money, the smart money that ultimately drives major market moves. When volume patterns contradicted his position, he respected that message rather than ignoring it. The brilliance of this approach lies in its anticipatory nature. While price-based stops respond after support or resistance is broken, Volume analysis often provides early warnings before those critical levels are reached. It's like having a sixth sense for potential market reversals, allowing you to adjust your risk parameters before most traders even realize danger is approaching. This dimensional awareness represents a profound evolution in risk management.
You sure you opened at $4?
Indicator or technique, Livermore integrated multiple information streams into a comprehensive stop-loss methodology. Now, let's examine how these 5 rules can work. Together as an integrated system, if you've noticed how volume often tells the true story behind price movements, type "volume never lies" in the comments section. The true power of Livermore's approach emerges not when these 5 rules are applied individually, but when they're integrated into a comprehensive risk management framework. Livermore recognized that markets are multi-dimensional, constantly evolving organisms that cannot be mastered through any single technique. His genius lay in synthesizing multiple perspectives into a unified methodology. For any given trade, Livermore would layer his stop-loss strategies in a way that created multiple lines of defense against catastrophic losses. He might use pivot points for initial stop placement, establishing the outer boundary where his analysis would be definitively proven wrong. Simultaneously, he'd apply time-based criteria to evaluate the trade's progress, ensuring his capital wasn't trapped in positions that lacked momentum. As the trade developed favorably, he'd implement his trailing
360, guys, 360. Oh, breakout 360. Whoa.
Giving the position room to breathe. This orchestration of multiple approaches created a remarkable adaptability. Rather than rigidly applying the same formula to every
That's crazy, guy.
Livermore's system evolved conventional market orders. If you place a market order,
that's crazy right there. 360. Squeeze. That's crazy, guy.
User. Cmbm. Calmness.
That's crazy, guy. So got squeezed up 472%. All right, let me see the nail. What the nail? Why does it run like crazy? Right here, the nail. Cmbm networks integrate with the Starlink. Ooh, they integrate with Starlink. That's all. For enterprise grade service. Yep, they're using Starlink for their network, guys. That's all. That's all. Yep. They work with Starlink, that's all. So what the heck? What the heck? So this guy's trying to pull out over soul. Look at that guy. Need to break 250. No follow on this one. I'm whole and hop right now. My price all the way up here. My price up here. Need to break right here. If not, I'm out. All right, Cmbm moving again. Look at that guy. That's a nice bear plot. Hold it again. Crazy price. Oh, $3.99 breakout. $3.99 breakout right there. That's crazy, guy.
Cmbm. Cmbm.
Hey traders, awesome to see you all here again. Thanks for joining. Just an important announcement, this stream here is delayed if you want to get access to the live features, so the live stream, the live commentary, access to our private Discord room chat, then use the link that we have in the description just under this video, guys. And also I would like to ask you all kindly to hit the like button, subscribe to the channel if you haven't done that already. And again, I'll see you guys out there. Thank you.
TTM. Cartesian. Image. Cmbm. Cmbm. FTNC. Cmbm
Dumb right now. That's crazy, guy. Dumb, huh? All right, check out this one, guy. Why? Look at that. It pump right there. Crazy, huh? Why, guy? Why AI pumping? Resistant all the way up here, crazy. Something going on, okay? Look at this one, about $200 a couple of days ago. Come on, break it. Tomorrow can go $3, okay? $3 tomorrow, guys. $4, crazy. I said right here, look, pump right here, pull back, all the way now, all the way back down here. $3, guys, $3 support.
Hey traders, awesome to see you all here. Again, thanks for joining. Just an important announcement, this stream here is delayed. If you want to get access to the live features, so the live stream, the live commentary, access to our private Discord room chat, then use the link that we have in the description just under this video, guys. And also, I would like to ask you all kindly to hit the like button, subscribe to the channel if you haven't done that already. And again, I'll see you guys out there. Thank you.
NBC. NBC. GGB. GGB. NBC. Line. EKB. DKB. 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 INSR. CKB. CKB. Cmbm Yyai.
All right, guys, I go to the gym right now. Look at this. Okay, Yyai reversal. Okay, look at this one. $3 support. Come on, man. How do I know that? $3 support right here. They say $3 support. Boom. That's crazy. All right, and this one reversal right now. If this one break right here, 270. You see the moon, okay? 270, good one. Crazy, guy. Look at it. Look at curve back up. Oh man, oh man. This one can go higher now. $4. Yyai. Make more money, I buy this one right here. Okay, that's it, guys. This one tomorrow. Be careful. This one tomorrow. Right? This one tomorrow. Look at here. All the way to $3. You break 3, go higher. Okay. So something happened right now. This one. Yyai. Whoa, whoa, whoa! Look at this one, guy. Look at this. $3. $4 resistance. Crazy, huh? Who pump right here, guys? Look at this one. This is a good breakout right here, guys. $0.70. Come on, you can do it. $0.70, you can do it, guys. Look at this one. Whoa! Fall apart! Break it! A short squeeze at the lung, up out, short squeeze, guys. Let it run, okay? Watch two. I watch two of them. I watch out this one and Yyai.
HRTX, CMB, HUBT, FPGA, CTNT, ELA, SDMB.
All right, bye-bye, guys. See you guys later. I'm done.